thanks for joining me on my market report. My name is Mike. My market report is on mortgage rates. We discuss what's impacting mortgage rates on a daily basis, whether it might come from the economic calendar, could come from the headline news, or a combination of that with geopolitical. But sometimes it gets confusing with the markets when the market sentiments change, and good news is now bad news, and vice versa. And if you're just kind of watching along, it may be you may not understand or know when this happened or why this happened. We try to give explanations as what's going on in investors' mind, so that way you can hopefully make an informed decision. If you're just in the industry, hopefully this will be the news that you're looking for, just to kind of help you for talking points. If you're a consumer, maybe looking to buy or refinance, you might be kind of following rates. Hopefully these informations will give you the information you're looking for. If you're following rates, you're probably looking to, if you want to lock in or try to float a little bit longer. Floating means that you're just kind of holding off locking and just waiting to see if you get a better rate or not. Hopefully this will give you the information that you're needing to make an informed decision for what you're looking to do. A little bit about myself is I'm a loan officer. We do loans in all 50 states. I work with the national lender here. So if we can assist you guys with any refinance or purchase, we'd love to be able to have that opportunity. Please reach out. But more than that, we'd like to be a resource for you folks. If you guys got questions about anything, we'd be more than happy to answer any questions you might have. So without further ado, please, without further ado, we'll jump off. Typically, I start off with the economic calendar, but today happened to be an empty day. We don't have anything on the calendar today. However, the rest of the week is pretty packed. I'll take a quick look here, see what's ahead here. So tomorrow, as you can see here, we got durable goods. We got Case-Shiller HPI, which is Home Price Index. Another HPI by FHFA. They are the ones with conforming loan limits. We got consumer confidence, and we got new home sales. And then we go on to Wednesday. We got pending home sales, or pending home sales. And then Thursday we got jobless claims but we also get the GDP. And then last but not least, the big one this week would be the core PCE this week. And we got Chicago sentiment and the consumer sentiment. But core PCE, this is the Fed's favorite gauge for inflation. What investors are looking for, because inflation has been on everybody's minds, and this is what's driving the Fed policy, is that they're kind of under the assumption, or at least believe, that it potentially is peaking right now, and they want to look at the data from the core PC to see if it indeed is showing that maybe inflation is peaking. So stay tuned. That will have probably the biggest impact this week. Will be on Friday, depending on what that data will be. So what's going on today? Well, what's on investors' minds right now? Stocks are down, but the stocks are taking its cue from the lockdowns in China. They've expanded their lockdowns, and that, of course, is it's a kind of a double-edged sword here. Now, it resulted, because of the lockdowns, it helped reduce the price of oil, which dropped below $100 per barrel. That in itself kind of helps short-term inflationary pressures and less demand. So there's less consumer demand. However, it could bottleneck. It's also going to bottleneck the supply chain, which we depend on China for a lot of our goods. So in terms of that, that could also create higher inflation in the longer term. As we're waiting for those shipments to come across, we may not have a lot of those items here to be able to purchase. So it's, again, a double-edged sword, where we got short-term, it's relieving some pressure on inflation, but on the longer term, depending on how long these lockdowns last, it could affect our supply chain even more, and therefore hit us with, again, more inflationary pressure as a result of that. So, because on the short-term inflation data, stocks are getting hit because they're looking at more of the lockdowns, and it's going to slow down growth as we go forward as well. That's how they're looking at. On the bond side of things, we're looking at possibly lower inflation, and right now we're seeing, as you can see here, this is helping us out. So we're up about 70 basis points. So what does that mean? It's translating into better pricing for us. We're looking much better today than we did last week. As you saw, we've been seeing this go downwards. Now, don't be too optimistic. We don't know. We still haven't yet determined if we've hit any floor yet. However, again, we have to kind of watch it. We've been getting a lot of head fakes. We'll have a day or two where it looks good, then all of a sudden, boom, we get hit with some really bad days, and it keeps declining further and further. So we get this like channel here. We go downwards, and it still fits in within that channel where we are the uh, upper end of where the channel is moving towards. Long term we're looking downward. We're moving downwards, but we'll have some ebbs and flows. Where we're going up and down. Hopefully that makes sense. It's kind of like somebody walking up or down on a ramp and swinging a yo-yo is how if you want to picture it to take a look at it. So here's how the volatility is today. So we've seen this steadily incline, which is good news for us. We did have a pause here for a little bit, and then it took off recently over the last maybe hour, half hour or so. Uh, and then let's take a quick peek at treasuries here, and treasuries dropped a bit too. As you can see here, we're right about here, about the 2 point. Where were we? We were at. It's not giving me that, but we're up pretty close to like the 2.9-ish range. Now we're down to about 2.77 range right now. So we have a pretty big drop in terms of treasuries, which is good news, adding less pressure on mortgage-backed securities. So last but not least, we'll touch on what's going on with the average conforming loan limit rates for the average loan limits. These do have points built into them, so take that into account. So 30 years now at 5.39, and the 15 years now at 4.82. So these are, as you can see, been slowly progressing upwards, and well, I don't know if you could say slowly, since we've gained over 2% over this year in less than 6 months. So that's actually pretty quick. But as you can see, we are having a dramatic effect in terms of mortgage rates. So, anyways, you guys got any questions? Please reach out. If you guys want any rate quotes, we're here to help you guys out. Again, and please feel free to reach out anytime. If you guys like these videos, please help us out. Smash that like button, share. We greatly appreciate you folks. You guys have a great rest of your day. We look forward to see you guys in tomorrow's video. Bye-bye.